Hi, welcome. In this session, we are going to discuss the theory of rational expectation and how theory of rational expectation going to play a crucial role in determining the prices of stocks as well as alternative assets. And this theory of rational expectation is also called as the efficient market hypothesis, and otherwise also called and also known as the theory of efficient capital markets as well. So, the theory of rational expectations is in contrast to the theory of adaptive expectations. So, according to the adaptive expectation, expectations are formed from past experience only. This is one of the Keynesian proposition, and changes in expectations will occur slowly over time as data changes. However, according to theory of rational expectation, people use more than just past data to form their expectations and sometimes change their expectations quickly. In other words, just using the past data, the past experience, historical data, expectations are not just based on the extrapolation of this historical data, but the very recent information or whatever the all available information, that all will be imputed in while forming information, while forming expectation and translating this expectation in determining the prices of assets. So, the theory of rational expectation, the expectation will be identical to optimal forecast using all available information according to this theory. Even though a rational expectations equals the optimal forecast using all available information, a prediction based on it may not always be perfectly accurate. It takes too much effort to make their expectations the best guess possible, and the best guess will not be accurate because the predictor is unaware of some relevant information. So, one of the things we need to remember here that the theory of rational expectation, that is based on the proposition that the market participant, they take into account all available information. The optimal, then they will make an optimal forecast using all available information, but it is not necessary that the prediction based on it is going to be perfectly accurate. Then again, maybe because the economy is very dynamic, it includes so many socio-economic, political factors, so all this will be keep on changing. So, what are the new information coming, that also will be feeding to the optimal forecast. So, that means this will be keep on updating this, that is the one of the proposition of rational expectation. So, based on this, let us make a formal statement. So, that means here x raised to e is the expectation of the variable that is being forecast, maybe stock price, this is stock price, and that is xc is going to be x, or that is the optimal forecast using all available information. So, in this case, what the rational expectation theory say that they say that the expectation of the variable, the stock price being forecast, is going to be the stock price, the price of the stock based on that is the optimal forecast using all available information, not just historical information. So, the incentives for equating expectation with the optimal forecast are especially strong in financial markets. You know that in these markets, people with a better forecast of the future get rich. They make more profit or more capital gain when they make use of all the available information. It is not only individual, but also different with the participant financial institution, for example banks, insurance companies, pension funds, whoever is playing in the market, all of them, because this involves lots of stakes, it's not a small amount. So, they are going to get as much as information. They have actually incentives equating expectation to optimal forecast, because they know that to get the maximum benefit, to get the maximum capital gain, they have to make use of the best use of all the available information. So, the application of the theory of rational expectation in this way, it is very important to financial market, is thus particularly useful. let us apply the rational expectation in a financial market. More importantly, let us apply this into the stock market. So, we have seen in the discussion previous session that the rate of return from holding a security equals the sum of capital gain on the security plus any cash payment. So, in the case of bonds, we have seen that the interest income plus the capital gain, or in the case of return in stock price, we can see that the price difference, that the PT plus 1 minus PT plus D. So, this is the capital gain and this is the dividend, right, and this is the current stock price. So, this the R is going to be the price of the is going to be that is the return, rate of return on the security. This is a function of the difference in capital gain, PT plus 1 minus PT plus D divided by PT. So, this is the R, this is the rate of return. So, in this case, let us apply how rational expectation plays a role. So, we can see that at the beginning of the period, we know PT and D, right, we know both PT and D, and PT plus 1, what is going to be the price of stock in the next year? Obviously, you know that this is unknown and we must form an expectation of it. So, in this case, the expected return, then we need to restate the return, we need to make the expectation, and similarly the price of stock in the next year, we need to make an expectation PE, P raised to E T plus 1. So, that expectation we need to make. So, in this case, what you can see that expectation of future prices are equal to the optimal forecast using all currently available information. So, this E component we actually need to equate with the optimal forecast, not just the expectation of next year based on the historical data, but using all available information we need to make OF, that the optimal forecast. Then in that case, we are going to get this RE, that the RE is going to be the return based on the expectation is going to be the return based on the optimal forecast. So, supply and demand analysis states that RE equal to the equilibrium rate of equilibrium return R star, that is the equilibrium return. So, in this case we see that if we apply the rational expectation, according to rational expectation theorem, they say that the return based on the optimal forecast is going to be the return that is determined by supply and demand factors, that the R star, the equilibrium rate of return. How? So, let us see how they explain it. Suppose that let us start with a scenario. Obviously, what we need, that actually they are going to say that this part, that is what we are going to say. Suppose the market, the current condition is that the optimal forecast, the return based on the optimal forecast is greater than the return determined by demand and supply condition. Suppose in that scenario, what is going to happen? That means the market participants who are having more information, they are having lots of information information about various aspects about the market, about the present and future. They see that based on that, they calculate that the return from this stock is going to be greater than what is determined by the market, that is the R, the demand and supply. So, in this case, you know that those who are having this superior information about the market, they are going to demand these stocks, and obviously you know that when the demand for this stock increases, you know that the rate of optimal forecast is decline. How come? Because we have seen in this formula that when the stock, this PT, when is keep increasing, because of these factors we have seen that here, because of the huge demand, those who are having more information, those who thinks that based on the optimal forecasting that the return is less, the actually the market determined rate of return is less than the optimal, what the expectation, based on their expectation. So, then accordingly what they will think that the demand for stocks, it is going to increase. Then when the PT increase, then obviously you know that the capital gain, finally the capital gain, the gain that is from this holding the stock is going to decrease. That is because the current itself, this year itself, the price of stock is going to this is going to increase, right. So that net difference, that what is going, the difference between the stock price next year minus the stock price this year, this gap narrow down. As a result, you can see that the R going to decline. So when the ROF is greater than R star, you can see that finally the return of optimal forecast, this one is going to decline. So suppose take the alternative scenario, what is the market participants think that those who are based on the optimal forecast think that actually in this market the price should be less than the equilibrium, the return should be less than the equilibrium return determined by demand and supply, then their demand for this stock decline, demand for stock decline, the price of T decline. So you can see that here when the price of T declines, then obviously you know that this rate of return, this is going to increase, right, because the capital gain, the different this capital gain increases, then the return increases. So in this way, if this one suppose this ROF is not equal to R star, then due to these forces you can see that there is a tendency to reach to the final equilibrium. The final equilibrium will be at this point. That means ROF is going to be equal to the R star. So in an efficient market, what it says that actually all unexploited profit opportunities will be eliminated. So ideally what they say, that they argue that the proponents of this hypothesis argue that in the market there won't be any unexploited profit opportunities. Always market participants, they try to get all the information, they make best use of the all available information, then accordingly the rate of return based on the optimal forecast is going to be equal to the market return determined by demand and supply conditions. So the efficient market hypothesis, this is also another version of rational expectation hypothesis. What they say that in an efficient market all unexploited profit opportunities will be eliminated, and according to them security prices are always correct and reflect market fundamentals, not only about the present, that also the future. So all this one will be feeding to the rational expectation, and accordingly security prices are always correct and reflect market fundamentals of present and future. And not everyone, also they argue that not everyone in the market must be well informed. Even some participants, when they have more information, then accordingly this will be reflecting in the market, then this ROF is going to be equal to R star. So what are the implications of efficient market hypothesis? So according to this market hypothesis, efficient market hypothesis, we can see that current prices in a financial market will be set so that optimal forecast of a securities return using all available information equals securities equilibrium return. So according to this hypothesis, one of the implication of this hypothesis is going to be that one investment is as good as other because the securities prices are correct. A second implication is that a securities price reflects all available information about intrinsic value of the security. That means security prices are always correct and reflect market fundamentals of respective firms. So when I say market fundamentals, that means not only about the present of the market fundamentals, but also of the future as well. So all this will be fully getting reflected in the current security prices. So an indicator of the financial health of the economy as well. So the stock prices, the prices of securities also can be considered as the indicator of financial health of the economy. So we can see that security prices, sometimes the managers of the firm, they can also take knowledge from the market, its own security prices, which is determined by demand and supply forces in the market. They can also learn from it. Security prices can be used by managers of firms to assess their cost of capital accurately. These are the major implications. So, in this case, let us ask, do stock prices always rise when there is good news? That means when we come to know that the economy is going to perform well in next year, the overall political and economic conditions of the economy is going to improve, then this is a good news. So, our question here is that, do stock prices always rise when there is good news? So, the answer is that stock prices will respond to announcement only when the information being announced is new and unexpected. When we are going to know that the next year, we already are aware, that means suppose one news came today that actually the economy is going to perform very well, or this particular firm is going to perform very well. But if this news is new, then only we can say the stock price will respond, and if it is unexpected. If this information is we already know, or already the market participants already made an expectation about it, they anticipated or expected this news, then this is not going to make any impact on the stock prices. So, in this case, should you be skeptical of hot tips? Somebody say that okay, this particular stock is going to outperform in the next year. So, should you be skeptical about hot tips? So, my answer here is that actually no abnormal profit exists. That means there is no unexploited, according to this hypothesis, the rational expectation theory, there is no unexploited profit opportunities in the market. So, there is no scope for any abnormal profit in the markets. So, in this case, do stock prices, let us revisit this question, do stock prices always rise when there is a good news? So, our answer is that stock prices will respond to announcement only when the information being announced is new and unexpected. So, according to what are the main prescriptions given by efficient market hypothesis to the foreign investors is that recommendation from investment advisors, according to this hypothesis, my point is according to this hypothesis, cannot help us outperform in the market, right? And a hot tip is probably information already contained in the price of stocks. So, stock prices respond to announcement only when the information is new and unexpected. So, one more proposition, the prescription by this hypothesis is that a buy and hold strategy is the most sensible strategy for the small investors, but not always. Let us also look, for example, how valuable are published reports by investment advisors. So, the information in newspapers and in the published reports of investment advisors is readily available to many participants and is already reflected in the market prices. So, acting on this information will not yield abnormally high returns and on average. So, according to the empirical evidence, for the most part confirms that recommendation from investment advisors cannot help us outperform the general market. And however, the efficient market hypothesis does not imply that financial markets are efficient. Some financial economists believe that all prices are always correct and reflect market fundamentals. So, items have a direct impact on future income streams of the securities. So, financial markets are efficient. However, prices in markets like stock market are unpredictable. This causes serious doubt on the stronger view that financial markets are efficient. For example, market bubbles and shocks like COVID-19. So, because of that, how markets performed. Before moving to this, let me also state that actually, so one of the point that we need to little bit more discussion, according to this optimal forecast, or based on that the return based on the optimal forecast, we say that this is going to be based on the return, based on the optimal forecast is going to be the return of demand and supply forces. What this hypothesis also say that there is no unexploited profit opportunities in the market. For example, taking the case of stock price, suppose during COVID, even after 5-6 months of the onset of COVID, you can see that India's stock market began to perform well. So immediately after, for example, in the month of Jan 20 to nearly March, April 2020, we know that the performance of Indian stock market almost crashed, but you can see that after a couple of months, still COVID pandemic was continuing, the Indian stock market began to outperform, right, after a couple of months. Why? Because then at that time you can see that the invention of vaccines and all came, and people came to know our understanding about the COVID, that also improved, and it became a new normal, and what they expect that maybe within a couple of months the pandemic will be over, then the economy will bounce back. So then you can see that because of this, the stock price, for example, here in this formula we can see that the stock price in the next year is going to increase. When they see that the stock price in the next year is going to increase, because the economy is going to do well after year 1, 2, 3, or maybe after a couple of years, and all this information will be influencing your current stock price. What is going to happen, that if you see that the stock price is going to increase in year 1 or year 2, that means economy is going to perform well, then because of that there is going to be an increase in the stock of that company now itself. So as a result, the stock, the PT, this is going to increase. So this difference, so as a result, the capital gain, that means the difference between PT plus 1 minus PT is going to decline. That means PT, because we see, so here that in the future when the economy is going to perform well, or the firm, the future is going to be bright, when you see that the future of this firm is going to be going to be bright, going to be good, then as a result the demand for this stock is going to increase now itself. So because of that, the difference between this decrease. That means if the actually based on that, actually in the future, actually this firm is going to perform well. That is what our forecast, optimal forecast. Because of that, the demand for these firms stocks increases in the present itself. So this will be already, as a result, the present stock price, the price of the stock increases in the current period itself. So as a result, the difference between this already reduces. This difference between PT plus 1 minus PT reduces. In contrast, if we see that the economy is going to perform badly in the future, then obviously you know that the PT, this is going to be reduced, because the reason is that the demand for that particular stock is going to decline. So in that way the gap is going to increase. So in order to understand how security markets, the finance market works these days, another area is also another area of finance is well discussed, that is called behavioral finance. That means the role of social science also required in understanding how stock prices or the security prices are determined. So in this case, the role of social science like anthropology, psychology, sociology, etc. are being incorporated. So in this case, one psychological aspect is called the loss aversion. That means the lack of short selling, because that means when the people in a society, in an economy, if they are outweighted with the people with the loss aversion, in this case you can see that this will causing overpriced stocks because lack of short selling. This will be explained by loss aversion. Another is overconfidence. Overconfidence means a large trading volume may be explained by investors' overconfidence. So the stock market's bubbles may be explained by overconfidence and social contagion as well. and also there is a difference between beliefs and facts. So what we studied in the rational expectation, that actually the facts, the people take into account all the available information, then they make an optimal forecast, and because of that the market's fundamentals will be reflected in the stock price or the prices of security. But actually the beliefs also matters. No, not always the beliefs is going to be a true reflection of the facts. One thing, actually most people, this is actually sometimes they have their own kind of overconfidence or beliefs about the markets. One example we can give, for example, somebody is driving and somebody is sitting just in the car, some driver is driving. So when someone is driving, then he will be thinking that he has more confidence on his driving and he thinks that no accident is going to happen. That is just a belief, that he thinks that he is overconfident. But when the same person sitting on a taxi, someone is driving, the driver is driving and he is just sitting, and he sometimes think that the probability, there is a probability of some kind of accident, right? When you look at the probability in both scenario, when he himself drives the car and when he is just sitting in the car when someone else is driving, then obviously there will be some difference, because he himself think that he is more confident about his driving, and because of that you can see that he think that there is less probability of accident. So this actually will reflect in the market as well. In the markets, people they think that those who are investors, those who demanding the stocks, he thinks that he knows more information, he has more confidence in the market. So that actually, like that, there are a large number of buyers and participants, market participants. So all of them having this kind of psychological, these aspects, this will be reflecting in their behavior. Then this will be also affecting the market bubbles, the fluctuations in the markets. So accordingly we can see that psychology of trading. So here actually you can see that 14 stages of investors emotion, all these will be affecting in the market behavior. So look at, for example, optimism. So if individuals are overrepresented with optimism, so even something happen, even COVID kind of shocks happen, they think that oh really this will be overcome within a couple of months, so no need of panic selling, right? So that kind of optimistic behavior, people with optimistic behavior, if market is overrepresented with optimism, then the market won't be clashing, right? So similarly people with the excitement, some hot news, they respond. Similarly all this psychology, all this aspect, anxiety, denial, all this going to reflect in the market behavior. So accordingly we can see that what we see, the stock market, how stock market performs, sometime bear, sometime bulls, and all this also will be in addition to the rational expectation, whatever we have seen, in addition to this, all the psychological aspects also work into context. So thank you.